We start today's market talk. Almost everything is in some way a derivative of what happens globally, whether through tariffs or wars. So, simply putting it, there are very few pure domestic stories anymore. So you can't say that this sector, this stock will not be impacted by global turmoil and other problems. Everything gets impacted some way or the other. For example, there is a problem of sulfur and sulfuric acid due to this problem in Middle East, and it finds application in fertilizers, manufacturing, metallurgical processes, and the problem of both sulfur and sulfuric acid have created a sharp shortage that would keep the basic chemical prices elevated in near terms. So they should benefit local producers, but those people who are using this are impacted. So there is nothing which is not, not connected adequately. So the basic point is that the Hormuz Strait reopens. That is what the market is thinking, and then the market is thinking that the war is over. Now market is reacting to every news, uh, but there are obviously ifs and buts. Growth downgrade by the IMF chief, US and Iran peace deal. Even if they move forward, it may still take at least six to 7 months to come through, and they would impact so many things. If the global growth goes down, it will impact the global steel demand and all the other consumption issues, etc. So, but what happened this week was S&P 500 hit an all-time high, and the CBOE VIX, that is the US VIX, the Wall Street's fair gauge, it is back to pre-Middle East war levels. So that means they have discounted the war, and now they are above that. So they are factoring in that this strait will reopen, and oil prices will come down, and markets have declared that the war is over. The guns, though, have fallen silent, not just in Iran but in Lebanon too. So right now the conflict has stopped. So market is thinking that it will not escalate from here. It is believing a scenario where conflict de-escalates, supply chain normalize, and growth stabilizes without inflation surging. Very difficult to take place. But right now, markets are believing that, and that is being reflected in the prices. More importantly, Iran is saying they will open the Strait of Hormuz, and crude prices have fallen sharply because of that. But we don't know how this will play out. Already there are conflicting talks coming from various quarters, so we don't know. But the immediate effect is there is a growth downgrade because of significant infrastructure damage, supply disruptions, and loss of confidence. And the other point is energy is not just another component, it is the system's transmission mechanism. It feeds into fertilizers, transport, manufacturing margins, and eventually consumption. So it impacts everything. Right now in India, SIP investors have held firm, continuing to provide a steady inflow for the markets. So markets are believing that things are normalizing, and that's why they are going up. So let's see how it plays out. But right now, one has to be slightly careful because the markets are too bullish. Now we have seen, as such, FIs have sold. So if you see, they have sold big time, more than a lakh crore in March, and even now, though they have slightly shifted to buying in the last 3 4 days, but SIP inflows, as I was mentioning, have held firm. So which is good, which is keeping the Indian markets firm and have not collapsed. Now, because of the various RBI action, the dollar rupee has stabilized at around 92, 93, and we'll have to see what is the trajectory from here, whether it depreciates or remains at these levels. Now, coming to FIDI data, if you see here, FIs are net short in index futures. They have bought calls and sold puts in index options, right? So they have bought calls and sold puts. So they are turning medium bullish. That is the point. They have started buying in cash. They have reduced their short position. So they are turning medium bullish. Pros, they have bought index futures They are net long. They are net long in on index options. They have bought calls and sold puts. So they are also strongly bullish. Clients, clients are they are net long in index futures, though they have reduced their long positions. They have sold calls and bought puts. So they are turning medium bearish. So I don't know. So right now the tables have turned. So FIs are turning bullish, pros are turning bullish, and clients are turning bearish. So they are booking profits or closing their positions, and DIs are selling in cash market while FIs have started buying. So if you see here, last week, if you see 4 trading days, uh, net FIs are flat and DIs have sold. So the last 2 3 days, DIs have sold big amounts and FIs have bought some small amounts, and they have turned bullish in terms of their futures and option positions. So that's why the markets have started moving up uh, from the levels it was there at around 24,000. It has moved to now around 24,300 odd levels. Now coming to the US, US bond yields have come down on the hope that there is a ceasefire. Dollar index has also come down, so that should benefit all metals and emerging market currencies. Brent crude has also declined. Last week it declined around 2%, but it is on a longer trajectory below 100 odd levels. So once it broke that 100 level on the announcement by Trump, then it has fallen to around 90, though it has pushed up a bit, but still it's on a downward trajectory. Gold is now started moving up. Money is moving back into gold. Similarly with silver, it was up 6% last week. Copper also it is moving because now the dollar is declining. Bitcoin has moved up. It went up 7.8% last week. So it has moved up from that 70 level. It is moving up. So it is behaving like a high volatility Nasdaq stock or a tech stock. So it is also moving up. So the bullish, you can see the bullish texture in the US markets and commodities. Nasdaq made a fresh high. So it was up 6% last week. Similarly, S&P 500 was up 4.5%, made fresh highs, and Dow Jones is also up 3%, but it is also moving up. So US indices made new highs due to ceasefire deal. Uh, what is expected is that both countries will return to Pakistan next week for a second round of peace talk, because the ceasefire is expiring in, I think, on Tuesday. So we'll have to see. But Strait of Hormuz remains closed, so that is very critical, and that will decide the course of how the things move from here. And in addition, U.S. produces price index, that is, their inflation came below expectations, and U.S. exports also climbed faster than imports. So generally, there is a bullish texture in the U.S. markets. India VIX, if you see, decline. It has come down to around 17 level. Once it comes below 14, 15, then it will become okay. Now Nifty from the total fall has retraced 50%. So once it trades above this 24 to 300 to 79 odd level, it can easily go to this 24 800 odd levels, which is the 66% retracement, 61% retracement, and then we will see from here. In terms of daily chart, so if you see here, the support is it made a low. So last 3 days after the gap up, it has made a base at this 24 100 level. So that should provide a support. The higher level is around 24 350 odd. So that is immediate resistance. If it trades above that, then it can head to this level of 25,000 with, and it has to cross this 200 EMA here. So there is a 200 EMA at 24,850 all. That should be a resistance. So if it trades within this zone and on any positive news, it can head to 25,000, and then with short covering, it can go back up. So this is what is Nifty doing. Nifty Bank was also up 1%. It has also, see, we had an ending diagonal pattern, and after that we are retracing. So it is also retracing the fall, and if it goes above this 57,000 levels, then it can also head back to 58, 59,000 levels. Here also, see, this is a daily chart, same pattern. it is made, it's making a base at 56,000 and getting resistance at this moving averages which are here. But once it breaks above this 57,100 this level, then it can head much higher. So the level is this 57. The 100 EMA is at 57,068. So beyond this, then it is in a blue sky. Reliance has taken support at its 200 EMA at 13,100 odd. One stock which moved very well, all the capital market segment, among them BSC, it's moving really well. So it has hit that 3,600 level, and now it is grossly overbought. So let's see what happens, but it is expected to do well, and it has broken the previous top of 3,200 odd. Midcaps have, as I had mentioned, to look into midcaps, and they are performing well. So they are heading to 14,000 and make a fresh high before Nifty or Bank Nifty. Small caps have also bounced back from the lower level. So the broader markets are doing well with good volumes. Now coming to earnings, the HDFC Bank earnings, if you see here, income statement, they are standalone. The net interest income was up 3% year on year, and for Q and Q it was up just 1%. Net interest income is the basic income of the bank, of the interest they are taking from the customers and interest they are giving to them, to the depositors. So difference is net interest income. So this is not growing as such, it's just flat. Non-interest income was up around, for the year was up 9.7. Net revenue was up around 5% and flat Q on Q. Operating expenses declined this quarter. Provisions also declined, and for the year also, and that helped the profit before tax and profit after tax. So just because provisions were lower, they were able to come to a profit of around 9.1%, 9% for the year. Not very encouraging. Now, if you see the consolidated income statement also, net revenue for the year was up 8%, and consolidated profit was also up around 7.4%. So whatever is the present situation, this is a kind of a reasonable number in the present circumstances. But don't expect the stock to rally from here big time. Now, if you see, they did around 12.8% deposit growth and 10% growth in advances. They are trying to increase their deposits more than their advances because they want to bring their credit deposit ratio lower. So net interest income was up 3%. As I had mentioned, net interest income was up 3%. So that is a trajectory. And NIMs are at around 3.38%. So net interest margin. So the rate, this is basic EBITDA of the EBITDA margin of the bank, at the rate at which, difference between the rate at which they are lending to the rate at which they are borrowing. So this has to go up for more earnings. Profitability has improved. It was up 9% as we brought out year on year, and earnings per share was around 12.5 this quarter. So if it was 12.5, assume 50-55 for the next year, at best 55. So the stock is roughly at around 16-17 times right now. Oh, sorry, 15-16 times. And average number of shares is the same. So this is EPS which is standalone. So the if you see over a period of time, ROA assets have grown, but the ROA return on assets is around 1.9. It is stable right now. It has not moved down, but it has not moved up. And ROE's trajectory has also been coming down. So from 20% ROE return on equity, they have come down to around 14%. So that has to improve. So so if you see here, the book value in terms of consolidated book value, it's now Q4 March is 381. So this was around 341 in Q4 March 25. So basically they have done around 10-11% growth in book value. So if this is 381, so assuming it can be around 420 or 420, 430 for FY27. So considering that, with the present price, the stock is at around 1.6, 1.7 times price to book with all its subsidiary added and all that issue. So it is not very expensive. So just to summarize, steady performance characterized by single-digit profit growth, improving asset quality, and focus on stabilizing its credit-to-deposit ratio. For the second consecutive quarter, deposit growth 14.4%, meaningfully outpaced loan growth 12%. This is a deliberate strategy to lower the credit-to-deposit ratio. They are trying, it was above that. Post merger, the credit to deposit ratio was above 100%. So they were lending more than what they were taking deposit. So they are trying to do that and reducing their lending, providing the bank with a much needed liquidity and long term stability in NIMS. Now, NIMS margin, as I showed you, was around 3.38. Credit costs were contained, reflecting the bank's conservative underwriting despite broader macro stress in unsecured retail segment. So, bank has been, it can lend more, but they have been a little bit conservative so as to reduce their NPS, etc. Now, what is market waiting for? From 3.38, this NIM margin should recover aggressively and a clear signal that the merger-related deleveraging phase is fully complete. The problem is they have legacy deposits of HDFC which are at higher interest rate. So once those gets cleaned out in another 1 year or so, then the NIMS will improve. So market is waiting for that right now. And once the NIMS will start improving, the stock will start moving up. Now, the point is, these results at around $1,000 where it was there earlier were not good. But at 800, risk reward appears favorable for a mean reversion trade. Like price to book is around 2.1, that is trailing 12 months, but forward it is around 1.6, 1.7 times. So, what the stock recovery, a lot of FIs have sold this stock because of management issues. So it depends on the management restoring institutional confidence and proving that the merger's operational friction is now in the rear view mirror. So that is what the market is looking at. The downside is limited, but once these things improve, which will take some time, then the stock can move up. So this is a chart. So if you see here, there is a nice support at around 700 level. Stock went up to 725 odd and then has bounced from there. So if there is a dip, and you can hold this for long term, then it's a nice opportunity to get into this stock. But then you should not expect it to uh, move up immediately. It has recovered as with the other banking stocks because of geopolitical issues and other things. But it has also corrected a lot due to the problems which are related to the bank per se. Now, ICICI Bank, if you see here, for deposits grew around 11% year on year and 8% Q on Q, and loans advances have grown at 15.8%. So strong growth in advances vis-a-vis HDFC because their credit deposit ratio is still in 80, so they can still afford to be aggressive on this issue. So if you see here, their net interest income Q and Q was up 8.4%, slightly better than HDFC. Core operating income was up around 8%, again better than FDFC, and core operating profit was up 5%. Provisions declined drastically, so it has come to 96 crores from what was in Q3 2026, it was 2556 crores, 2556 crores. It has come down to, and that has 96 crore, and that has helped the profits. So profit after tax is up 8.5% this quarter just because the provisions are low. Otherwise, operating profits have not improved much as such. Consolidated, if you see, they are growing at around 8-9%, and operating profits are growing at around 4.7, and for full year, growing at around 6.3. So nothing really outstanding, and provisions dropped. So that has helped profit after tax go up by around 9.3% in a consolidated way also. So their NIMS, so if you saw the HDFC NIMS, vis-a-vis that, they are at outstanding 4.32, so that they are able to do well. ROA is also much better at 2.4, and return on equity is 16.6, much better than HDFC. Book value is around 492. So it has improved for FY26 now is 492, and see FY25 it was at around 429. So it has moved up around 15%. So expecting that, so it should be around 550, 560 plus next FY27. Considering that this stock is now forward it is around now around 2.5 times forward earnings. Now, to summarize, it continues to outperform major private peers in core profitability and asset quality metrics. Standalone net profit rose 8.5% year on year, driven by consistent loan growth and a sharp decline in provisions, combined with a contingency provision buffer of 13,100 crore, which they have created. The bank's balance sheet is arguably the best protected in the Indian banking landscape, because the point is that next quarter, a lot of bank may do some provisioning, higher provisioning, because there is a stress in the economy and there would be stress on their advances, etc. Its 4.3% margin is significantly superior to HDFC Bank 3.53 NIMS, giving it much higher breathing room in high rate environment. So one of the reasons why the bank's profit also improved last quarter was because the RBI had reduced the repo rate, so the bank had to give lesser interest to the borrowers, so that way their margins are improving. So right now, in case the interest rates again start going up because of this conflict, they have a better margin as compared to other banks. A steady contribution from insurance arms, ICICI Crude and ICICI Lombard, and its AMC business, which are currently benefiting from higher retail participation in Indian equity markets. ROA is near 2.3, still better than HDFC. It is extracting maximum value from its assets. Price to book is around 2.74, that is trailing 12 months. So forward would be around 2.5. So which it is not very expensive, seeing whatever this as per the size of book, the growth they are doing. ICICI Bank now, if you see, it had declined to this 1200 odd levels. From there, it has bounced back and bounced back very quickly. So hopefully, market should remain positive with these results. And if it breaks above this, it can go back to this 1400 odd levels. There were some expectation that results will be poor. So these have not been met. So let's see how the market reacts. Because right now, the markets are also moving along with geopolitical issues. Now, comparison wise, so if you see here, gross advances is nearly double. Total deposits are also nearly double of HDFC Bank versus ICICI Bank. ICICI showed faster loan growth, 15.8% compared to HDFC. HDFC prioritized deposit mobilization, 14.4% to balance its post-merger book. So they are nearly double the size of ICICI Bank right now, HDFC Bank. So for that size, I don't know what is that level of growth acceptable to the market or not, or valuations are not very expensive for that. Net interest income, NI's growth for ICICI was 8.4%, outpaced HDFC 3.2% on a year-on-year basis. So ICICI Bank has performed better. Profit after tax 19,000 crore and 13,700 crore. HDFC remains the profit leader in absolute terms, but ICICI is closing the efficiency gap because of better ROA and NIMS. So NIMS 3.38 and 4.32. ICICI maintains its significant higher margins profile and superior pricing power. Return on asset 1.96, 2.4. ICICI Bank is currently the most profitable entity related to its total assets. Gross NPA have also, HDFC Bank continues to hold the edge in overall asset quality. So that has remained pristine. 1.15 and 1.3, and net NPA 0.38 and all. So both these banks have maintained exceptionally clean balance sheets with minimal bad debt. P ratio wise, if you see, HDFC Bank is at 16.5 and price to book 2.1, and ICICI Bank is at 18 and 2.74. So ICICI has a higher earning multiple due to its superior ROE, ROA. HDFC Bank is trading at a relative discount compared to historical averages. So to summarize, operational efficiency, ICICI Bank is the current margin king among the big two. Its ability to maintain a 4.3% NIM while growing its loan book aggressively has made it a favorite for growth-oriented investors. HDFC Bank is still navigating the merger hangover. While its scale is massive, its margins are compressed as it replaces high-cost borrowing with retail deposits. valuation gap for the first time in years. HDFC Bank appears to be the value play. There is value now. While ICICI Bank is a momentum play, the market is paying a 30% premium on price to book for ICICI's superior profitability net. So this is the gist. Now we'll have to see how the market reacts. There is nothing much to lose from here for both the banks, because they have come to the lowest kind of valuations and they have very good subsidiaries which are also good businesses. I have finished. We'll take questions now.